Hello, this is Richard Wilson here at the Family Office Podcast. Today I have with me Supreet from Raven Capital. Raven Capital and the two founders have achieved a 65% IRR on their past venture capital deals. We're going to talk about that in a couple minutes. They've got a unique strategy of how they're approaching venture capital. Supreet, who we're interviewing here today, spoke at our investor summit in San Francisco, actually, just about a week and a half ago, I think it was. And he had one of the most engaging talks. So I think you're going to enjoy this interview. And we've only had maybe one or two, if any, venture capital discussions here on the Family Office Podcast after almost 250 episodes. So I think we need to bring more of that to the table because a lot of family offices have preconceived notions of what venture capital is or who should be in it or how it works. And, I'm honored to have you here on the podcast with us, Supreet, today.
Thank you, Richard. Very nice to be with you and your virtual guests out there.
Sure. And I know you got started in 1994, so you've seen a lot of changes and growth in the venture capital space. Can you comment just a little bit about maybe what type of perspective you've had over the last 25 years being in the space, and what's your daily perspective now in Raven Capital?
Sure, absolutely. So I've been in Silicon Valley since '94, inside venture capital, outside venture capital with almost an operator. I've run companies, I've built companies, I've run the tech in companies, and then I've also been on the VC side where I've helped companies get funding. But more importantly, I think the key differentiator is I've helped companies think through their go-to market and how does it matter and how do they serve their customers best. And you get so caught up in trying to figure out valuation and all of these other pieces, we forget sometimes that we're often serving the customer. And if a startup, especially that has to create escape velocity to get known, has to create visibility, and I think it comes from serving the customer best.
Sure. And I think that's exactly in line with what's been happening with WeWork and versus companies that do serve the customer and are tech related, like a Airbnb or someone who's had, real traction and, shown profits, at least at times, if not consistently. And sometimes I think a family office's view of VC is limited to just that, what makes the headlines, in the Wall Street Journal or in their Apple news feed, et cetera. So I want to talk about that in a minute. But first, I want to read off the one-line description that you provided me on your firm. Providing investors access to early-stage high-growth technology, AI, 5G, IoT investments through a new fund run by executives who have raised over $1 billion dollars and had a 65% IRR on past deals and are focused on developing positive cash flow. So I want to unbundle that a little bit. I think a lot of people know AI is artificial intelligence, 5G is a new cell mobile technology. IoT is obviously Internet of Things, but some people might not know that if they don't study the space at all. I want to kind of unpack a little bit on that one-liner. You could have chosen anything to say in that sentence. You chose to say those things. Could you comment on, the types of technology you guys focus on, and is it strictly limited to AI, 5G, IoT? Are those just examples? Like how much of your scope is in those segments specifically?
So I think of it two ways. There's everyday technology which we use, which has become mainstream, and then there's technologies that are going to be coming and will become mainstream. And as VCs, we're so the future. We're forecasters. We look at the crystal ball and we invest with a hope or expectation that we're picking technologies appropriately that are going to be successful. Now, why AI, IoT, and 5G is because while we think of other technologies and we think of many myriads of sectors, but in game changing shifts, which is what we're interested in, we call it revolutionary tech. These game changing shifts are so important because they move either the experience or an industry or a behavior set exponentially. Let me give you a simple example. So we had regular cell phones. Remember the old Nokia? Everybody had a Nokia candy bar, and we were at
Mm-hmm.
1G. We went from Edge to 1G. And it was revolutionary because we could actually do text. We could do multifunctional things from doing a single function. Because if you made a call, you couldn't do a text. If you did a text, you couldn't do a call. So then we shifted, and it was a technological shift, and it actually led to the emergence of the smartphones. People think, Steve Jobs invented the iPhone and the touch thing and all, but BlackBerry and technologies were actually the back end is what really enabled the ability to multiplex or to ability to do multiple things at the same time is
Hmm.
really what helped us get to the next level. If the capacity doesn't exist, then the product to use it can't be built. So we're seeing, so what is artificial intelligence if we break it down? Artificial intelligence is really systems learning from patterns that they can suss out due to programming code that says suss out the pattern and then leverage it. Now, if you take that and you layer it on top of a technology, 5G, which, if you think in the 60 millimeter wave, and getting technical, but instead, if you just think that in this new era, we will be able to transmit 10, 20, 100 times the data that we could with the current technology. So now you got an ability to transmit. So, for example, video that takes 10 minutes to download now will take a minute or less. So what happens is if you notice, if you let's take a demographic that you and I both see, the young
Hmm.
kids, a 15-year-old child, what I call them, they're digital natives. They grew up with technology native to them. You and I, we're older, we're digital, immigrants. We immigrated to technology, but we remember when there was very little technology. Well, these natives, I see them. The kids don't talk to each other, with texting or whatever. They send little
Hmm.
micro videos or micro audio, and what that happens is the context. We would have to labor context, and emoji is a cheap way or simple way to do it because the technology won't send big packets. But if you start seeing what people are doing with little videos, that's what TikTok is. So, is a technology with little video snippets. What's
Hmm.
happening is we are leapfrogging the scale of messaging to a very rich environment. Now, so why does that matter is because then if the AI helps reduce the errors so it makes sure the connection stays good from the back end, the
Hmm.
the speed enables rich, amazing things to go back and forth. And then the IoT is all these little beacons and sensors that allow a lot of the automatic behavior to sort of happen. An IoT sensor embedded in homes, for example, might say, Supreet's in his office and he's doing a podcast with Richard, or they're talking on the phone. I should mute all other devices, and it would happen automatically.
Right.
So that's the kind of leverage we think of 1 + 1 + 1 adds up to 111. And that's how I like to think of investing in people who then can see these visions and then try to make them real.
Sure. Sure. That makes sense. Okay. Well, what if we take a step back again to the one liner, $1 billion in capital raise? That's a lot of capital. Is that at three or four different firms? Was that at a big wirehouse bank firm or a small niche firm or a firm that some people would recognize the name of? Or how did you get that experience? Because most people, are proud to say if they've raised $100 million in their career.
So my partner Paul, who's not on the call, um, has this unique distinction that for in Canada, as you know, we're a Canadian-based fund, and in Canada,
Hmm.
he went to a ridiculous lengths to help raise money for different ventures in his previous incarnation, as I call it. Uh,
Hmm.
and I think it's not the amount is less germane, although it's a people can raise a lot of money with one deal. The thing is the systematic way and method with which he went to not only just raise the capital, but then apply the capital and deliver it. That 1 billion raised has resulted in $5 to $6 billion worth of value. And so
Sure.
we look at not just the raise. It's a nice little dangling thing to dangle out there, but it's really what value got created with that. And that's what we look at as that's what happens. In my previous incarnations, so to shift that to the IRR conversation, right? 65% IRR in previous deals. Again, it's not about the IRR, it's about how we got the methods and the discipline and the architecture to first pick the right people to support, and secondly, to help nurture and curate them to be able to deliver the very high value. So if you
Right,
combine
right.
the billion raised with a large delivery at the end and a 65% IRR, as a resulting, so what you end up with is seasoned. What we're really trying to tell people is we're seasoned operators who have both, we have the scars on our back to actually be able to showcase and have lessons that people can learn from to create value, long-term value.
Sure. Sure. I think a lot of people that speak to individuals like yourself or that look at a venture capital fund like Raven might not even know what the smart questions are to ask. So you're sophisticated in the space. You've lived in the space for 2.5 decades. What's one of the smartest questions that people should be asking you but never do, or should be asking you but only the most sophisticated who really know the space are asking you? Like, what would be one of those questions that you could provide investors that are listening here on the podcast today?
So it's funny, you're actually taking something that's in our tagline, which is how to get to positive cash flow. You'd be surprised how few people ask us about that.
Hmm.
And I think you mentioned WeWork right at the beginning, and WeWork has a dubious distinction, very good and very bad, in that their customer approach was really magnificent. What they did was revolutionary in terms of delivering value to their customers. And then what they did on the back end was so unrevolutionary, or so, it's almost like, how can you screw it up this way where you end up destroying value in a company? And I think this is the piece
Hmm.
of knowing the end to end, from womb to tomb, as I like to call it, is you can't just be good at one component to get us to escape velocity. You really have to get to not just what you do for the customers, also what you do for the middle, also what you do with your team, and also for how do you source and do the back end. Ask any motel guy. Don't have to have an education. In our Indian community that I come from is full of people with sixth grade education who run motels all over the world, and they know if
Hmm.
you ask them what's the occupancy rate at which you break even at 64%. If you can't do 64% occupancy rate, you aren't going to make any money. You're going to lose money. And last I checked, I think WeWork was in the 20s or 30s.
Right.
So some of these things, you don't have to have sophisticated degrees to go talk to people, but you have to. We may have investments where if a founder has a focus on cash flow, what we see is there is a huge amount of discipline, just not only self-discipline, but also discipline within the company to help keep, to manage money better. You can spend a heck of a
Right.
lot of money, but if you don't create value behind it, value comes from having discipline and managing your cash flow.
Right. Yeah, I like that answer because it doesn't try to make yourself look like a genius by having some sophisticated answer. It sounds like a Warren Buffett type answer of like, well, just don't invest in stuff you don't know. And then people who don't know Warren Buffett are like, well, that's obvious. Why would he say that? Just like, oh, well, look for things that have a path to positive cash flow. It sounds so simple, but nobody asks it. Just like we talk about values a lot, and everyone has company values, but very few have values for their family office. And nobody at the last event where I asked put their hand up saying that they had values for themselves and their family formalized on the wall of their house. It doesn't cost anything. So why aren't people looking at such a simple idea and putting it in place? I think that's similar to the comment you just made, which I think can be overlooked by some people as being something simple. But when it's simple and no one is doing it, then it's sometimes the most valuable thing to be doing because it doesn't cost anything to ask that extra question and see what the answer is.
Yeah, it's amazing. I was so glad you did that at the last conference, and when I was watching you, and it was the aha moment for me to say, this is the, if I didn't take any other nugget from the conference, this is the nugget I'm taking away, because I think the discipline and the structure it requires to talk about values or positive cash flow, or what I call common sense behaviors, allow us to mute our ego and really look at what, you look at it from a perspective of, I want a path to success without having the ego to say I am the end all do all. We have the the landscape is littered with Theranos and WeWork and others where huge amount of capital has been expended and to no value because the discipline required to say, wait a minute, what am I doing? What is the long term goal? Hey, by the way, I'm not a person who advocates don't go create growth. I'm absolutely pro growth.
Hmm.
But if you look at pro growth and you couple it with pro wealth or pro value, growth plus a wealth mindset always, always, always goes to positive cash flow.
Right. Right.
Only growth mindset, sure, you get eyeballs, but you don't translate them into value. And only wealth play allows you to protect your money, but you don't ever do any growth with it. So the trick here is how do you balance? It's a balancing act, and of course that's where the our history and the scars on our back allow us to be able to say what we're bringing to the table is way, way more. Our biggest thing is to nurture our investments to help them see the path to positive cash flow.
Sure. Okay. Makes sense. I wanted to ask you about tech trends, like your perspective. What are a couple of the trends? We started out the call talking about a few of them. Are there any others you didn't mention there that are big trends right now that you are focusing more energy on than everything else?
I think it's not really a tech trend as much as a process trend. Think of it this way: in many industries, a lot of the disruption that happens or is happening is because the industries have been reluctant to innovate on their own. Sometimes it's because they have monopolistic behavior. Other times it's, the customer hasn't demanded it, so why change and why destroy a good thing? And yet, when you look at creative destruction and you learn from, and maybe we're always going to be the leading edge of this and it's our bias as venture capitalists because we are going to lead the development of new things. I think when you go into industries that haven't changed in 100 years or 50 years or pick a time frame, you start looking at what are the failures. I always go and say, what are the big top three customer problems and who's solving them? And you'd be surprised sometimes like the problem is glaring right in front of you and nobody's solving it.
Right.
And it is that nexus that you say, okay, then you start thinking of what smart tech can we use. So I give you a great example. I know of a great startup. We're talking with them. They took imaging technology, which has progressed amazingly, and they can image fields of crops and tell you what disease is on the crop by week 4 after planting, as opposed
Wow.
to waiting a whole season. And they've got an AI based database that it goes through and says, aha, you've got blight XYZ, or you've got this boll weevil, or this bug, or whatever. And what that has shifted is the farmer's behavior. So you can go back into an area and go change, can either destroy the crop or replant it or put certain preventative measures, whether they're pesticides or others, that allow to save a crop instead of having a whole season and then destroying significant value. See, here's an example of, and it uses AI, it uses imaging layered with AI to go do all this. They go take a plane and drones and take films of fields, and then they go through their database and say, for corn, for example, these 20 images can show this thing, this thing, this thing, all 10 different variations, including healthy. So what people
Sure.
want is the check saying, okay, I'm healthy. But it's a very low cost compared to having to destroy the crop, not to mention the value and the effort and the labor that goes into it. And that's such an amazing way to think because if you think of food security and food tech, that's revolutionizing how that happens. Let's say in North America where we're very sophisticated in how we grow things, but imagine what that does in a poor country in the third world where the difference between a crop surviving and failing is actually famine.
Hmm.
It's very
Right.
hard. And so I look at that and I go, this is a
Hmm.
really important piece to think through. So it's you layer the tech, you look at good tech, which is new tech, You look at with a problem that is solvable, with then a team that is, capable and understands, how do we get there? How do we implement this?
Sure. So I want to ask you a question now that I think that'll be informative and related to what you just said. But it'll be informative to people on two different levels. One, you've been, you've raised over $1 billion, you've been in the space for 25 years, so you know the lay of the landscape better than most. If people are listening to this and they say, well, there's 10,000 or 3,000, you would know how many venture capital groups out there. What makes Raven Capital unique? As you answer that, it's interesting to hear how you answer it for those that are kind of new in raising capital for whatever they're doing. And then for those who are looking at the venture capital space and trying to figure out who to work with or if they should be allocating in it or not, I would like to hear kind of the answer that you're giving people every day when they ask you that. What makes you different? What's the misconception around the venture capital space, and really what sets you apart? Because a lot of people in the hedge fund space and private equity space, real estate funds, they say something that it's in a way they think it sets them apart, but then they're all saying the same thing. And I think it's a challenge because there's so many people out there raising capital in each niche. So I'd just like to hear your answer on that and how you've been describing your story to investors.
So we're unique in that we're maybe one of the very few venture capital funds that is a Canadian US hybrid fund. And I use the word hybrid to kind of, and let me explain what that means is we've set up our fund in Canada because Canada has a very good ecosystem for early stage investing. Uh,
Okay.
and then we're a US fund because the US has a very good ecosystem for growth and late stage investing. So what we are able to do by bringing companies into Canada is we're able to, for less capital, get more bang for the buck. Costs, as you know, Silicon Valley costs the same engineer that you can get in Silicon Valley for $250,000, you
Mm,
could get in Canada, in Toronto, for $120,000. And so when you
right.
start look, those are just labor costs. And most of we look at our companies that we invest in, we say, where is your very precious dollar that you gave up equity for going to get used? And if it's going to get used into the intangibles, but very high, cost of things like housing or just the cost of living, then that's inefficient use of the money. So we're trying to create a better efficient use of the money, yeah, and a more efficient use of the money by nurturing in Canada, growing them up to a point where they're then ready to come to the United States, and then bringing them to the United States to syndicate with other VCs to give them, to become smart investments. So we believe at Raven in what we call capital as a service and smart money. There's a lot of money. The valley's awash with money, and sometimes too much money. But I think if you
Right.
nurture and have discipline and focus, and you spend 24 months building them up, and then bringing them when they've got a good MVP, good proof of concept, a great team already ready, and then what you're doing is really going to growth. The What you're doing is reducing the risk of that it takes, because if you just start, and I know way too many what we call zombie startups now. They're just running.
Right.
They've been 24 months in the valley. They're running out of money, because they, even though they raised $5 to $10 million, they're running out of money because too much was spent in just the non-value add costs. You know, Whereas if you were
Right.
able to create that with value add costs, when a location is 40% less than another location, or 50% less than another location, it behooves us to use it. The other is the government of Canada is very supportive. Public monies over there are given in the form of grants, especially to early stage companies, which allow us to then be able to mentor them with monies that doesn't have an equity component attached. It preserves the equity to be used in the latter stage, which also rewards founders better, which rewards the investors better, and it creates that positive cash flow component. It gives us more runway to work with.
Sure. Sure. Okay, that makes sense. I mean, it's a little bit of an arbitrage of just what those markets value, and I guess the value of getting into the deal and then layering on top your cash flow emphasis versus just kind of burning through investor money just as fast as you raise it, which seems to happen, with
Yeah,
some early stage firms, right?
I'm very, very cautious. I think of investor money as very precious, and maybe I'm old school, in the sense that I come from an environment of getting things done. So having been an operator and rolled up my sleeves and making sure that people's lives are depending on money, people don't ever talk about this component, but it's very valuable to me, is that every time a company goes under, the number of lives it impacts are very, very high. Not just founders, but all the people who
Right.
come and make a promise to go work in a startup for equity and defer cash many times. They take smaller salaries to get more equity. It's a promise and a commitment which I have with my founders to make sure is like, if we're able to create better value, remember, this may not be the only company you're doing. This might be the first one or the second one, but what if we can set you up to do 5 or 10 over a lifetime? Think of how many people you touch and how well you can lift. That rising tide lifts all boats. I want to be part of that rising tide.
Right. Yeah, no, great point. Couldn't agree more on that. I mean, just the single family that one investor, might impact might be 5 or 8 people that are impacted just by something going well or not. So it's really kind of an exponential impact you're making on society when you do well by your investors.
Yes, and I want my investors to be successful as well. I want them to look at us and say, "You guys put our money to good use," and it's a very basic reason why we then, the next fund and the next fund and the next fund, they'll commit and give us more money. And this is a relationship it's a trust based relationship. It's a relationship, I think, that allows us to demonstrate we can create success, and for them to demonstrate that they have capital when we need it.
Sure. For those listening that have been to our workshops, that I talk a lot about deal sourcing. We're going to be talking about this on Tuesday a little bit at Capital Raising Catalyst, but we're going to talk about it at our Private Investor Advantage workshop as well. And how do you get the best deal flow after being in Silicon Valley and in VC for so long? Where do the best deals come from besides simply, I'm sure you have a massive network by now, so I'm sure you have many friends in the business, but what other strategies or sources get you your best deals?
So I think the Silicon Valley success is that they get a huge, tremendous amount of deals. It also has been sometimes overheated. I think one of the things we've discovered is, as we go around the globe, both Paul and I have DNA that's global, in the sense that I'm born in one country, raised in three or four. I was born in India, raised in Africa, England, France, and then came to the United States and traveled the globe. There is no monopoly for great ideas and people. So we will find teams and people and ideas being successful around the globe. And that, I think, enables us actually to be better custodians of investment money, because if we find a great team or a great idea and put a good team to it globally, what we're doing is bringing value from around the globe rather than just sourcing it in one area. That's
Sure.
a key metric and differentiator of us, that we call ourselves Born Global, but the fact that we're global, and I will tell you, I was just in Dubai, I just got back. I have seen from Africa, from Poland, from Ukraine, from India, all kinds of really amazing, amazing teams of people whose perspective on problem solving for customer success in just creating value in different industries, from fintech to ag tech to insure tech, all around the globe, but especially in med tech and some of the areas that we focus on, has just been marvelous. It's like, how did you even think that? It's sometimes I go home going, how did they think that? That's just so wonderful.
Right. Definitely keeps your job interesting for sure. So yeah, it's interesting you bring that up, that global perspective, because I've had Silicon Valley people tell me at our event in San Francisco recently, Oh, well, I see so much deal flow here in Silicon Valley. I don't need to ever leave. And this is the epicenter. So we see everything. And it's that very attitude that you're kind of playing against is, you don't see everything in any place, just like Tel Aviv or anywhere else. You're not going to see everything. So it's interesting that I heard that exact line and that it's kind of counter to what you were just talking about, right?
Well, we are contrarian on some things, and I think we have partners in Switzerland and Tel Aviv and uh, everywhere around the globe, Sao Paulo, Dublin, London. And what by being global, we're able to see deals. Maybe okay. They most likely are going to come to Silicon Valley at some point, but if I catch them earlier, because they're being global, and then I can take them to a place like Canada where they can be nurtured and nourished and built. I think we get it's about just tapping into that same network earlier. We're not getting overheated deals. We're getting deals at the right time so we can help them grow. And then we can harvest value. Think of it as instead of having one success out of 10 or two out of 10, I'm trying to get a whole bunch of singles instead of just a home run so I can have five successes out of 10, which, leads to the higher IRR.
Sure. Makes sense. That gets through the questions I was going to ask here on the podcast interview today. We'll have to have you back maybe next quarter or something to dig into a few other areas we just don't have time to cover while kind of keeping this in the normal time frame we usually try to aim for. But is there anything that you wanted me to ask you that I didn't, or anything you wanted to add in that you didn't get time to explain or you wanted to make more clear before we wrap it up?
No, I think we've covered quite a lot. I think as always, we're always looking for investors in limited partners who are interested in investing in a thesis like ours. And I think innovation is sort of core to what we do. And as I mentioned in our when we were at the conference that you had last week, is quality is really important, teams are really important, people are really important, and I think one of the key things we do is we like to get to know our founders and our LPs and create a community so what we can think of as a long-term ecosystem that brings success.
Sure. And if anyone wants to learn more, I just want to make sure they have the spelling of your name right. Raiven, ravencapital.com, for the spelling of the fund name and the company name, Raiven, ravencapital.com. Is there anywhere else they should find you online or any other good way to get in touch with you?
Yeah, we're on LinkedIn, and I think that's one of the best. And just, either Supreet at ravencapital.com, that's Supreet at ravencapital.com, or Paul at ravencapital.com. We're the two founding partners, or also info at ravencapital.com. They'll get to us. They can
Sure.
always talk to you, Richard, and you can just point them our way.
I was just going to say that as well. Someone on our team will help you find anyone you hear in our podcast. You might see Supreet at one of our upcoming investor summits, like you might have in San Francisco recently. And anytime that anyone listening to this podcast hears an investor we interview or an investment manager we interview, or you hear a discussion panel and maybe somebody kind of mumbles their firm name, or maybe our audio isn't world-class audio at one of our 30 events per year, hopefully not more than one, but yeah, we can always help anyone listening here get in connection with someone you hear on the podcast, which is no problem, especially if you're a member of the Family Office Club. But either way, we'll be happy to help you out. And thank you, Supreet, for your time here today. Looking forward to seeing you at one of our events again shortly.
Thank you, Richard. I really appreciate it, and really appreciate your hospitality last week here in San Francisco.
No problem. Take care.
Bye bye.